Okay, so what we'll be doing in this video is we will just be continuing on the financial statements of a sole proprietorship, and we're just going to do two comprehensive questions in taking into account the full cycle of our a full set of financial statements, how we deal with it, and how you will have to record and prepare your financial statements. Okay, remember, a full set of financial statements consist of an income statement, or the technical name or the correct name for an income statement is your statement of profit and loss and other comprehensive income. You've got a statement of financial position. You've got a statement of changes in equity. You've got your notes to your financial statements, as well as your cash flow statement. Okay, but we're not going to deal with cash flow statements in this video. So as a recap, what is most important in accounting is you need to know your formats. In accounting, you have certain formats, so you've got your financial statements and it has a fixed format on how it should look. And it's very important for you to know this format off by heart, because there's a lot of marks which you can get in just knowing and understanding how the format looks and accounting for your questions correctly according to the correct format. Okay, so what we'll be doing today is we'll be having a look at two comprehensive questions. One will be looking at the perpetual inventory system, and the next one would be looking at a question relating to a periodic inventory system. But if you look at our financial statements, what is the how does our financial statements formats looks? So just looking at a perpetual inventory system. Okay, let's start with our statement of profit and loss and other comprehensive income for the year. So this statement is used to determine the performance of the business, and it just measures the profits or losses made during a financial year. So in essence, it's just a statement form of your trading and profit and loss account. Okay, so remember, always focus on your easy marks in accounting. So always have your heading. So it will be, for example, ABC Traders, statement of profit and loss and other comprehensive income for the year ending 28th of Feb 2010. Okay, so that's an easy mark which you can get. Focus on those easy marks. So if you look at this statement, how does it look? We'll start off with your revenue. And what is revenue? Revenue is the sales which you made, less if there were any sale returns. And then we also need to subtract our settlement discount granted. Now, settlement discount granted is where people buy from you on credit, and you want to encourage them to pay back as soon as possible. So you will have certain incentives in place. So you will say, for example, if your debtor pays you back within 10 days, you will give them a 5% discount. So in essence, your sales will decrease by that 5%, and we're going to account for this in as our settlement discount granted. Okay. So we take our revenue, and in the perpetual inventory system, we have a cost of sales. And cost of sales relates to the movements in our inventory. So we're going to take our revenue and we're going to subtract our cost of sales. But from our cost of sales, we also need to subtract our settlement discount received. But importantly, is this settlement discount received should only relate to purchases of trading inventory. Okay, so not when you receive a settlement discount for the stationery that you bought. It's only relating to settlement discount received in terms of inventory. Okay, so our revenue less cost of sales gives you your gross profit. Now from your gross profit, you're going to add other income items, and we will have to pay our other overhead costs. So your most common other income items is going to be your rental income, commission income, credit losses recovered. What is that? Well, that is, for example, when you write off one of your debtors, so they've been declared insolvent and they can't pay you back anymore, so you will write off this guy or woman as a credit loss. So it's bad debt. We know we're not going to get that. But if this person comes to you a year or so later and he decides he wants to pay you back, then we're going to account for that as an income because we already wrote them off as a credit loss, as a bad debt. But now it's going to be an income to us because they paid us back. Okay, so that's your credit losses recovered. Interest income. Interest income, we have a note for interest income. We want to know separately what are all the different interest income which we can which we earn. Okay, so you will have to look at note number 1. So if you go to our notes up to our financial statements, and these notes are essentially just, it gives more information of these line items. So in your statement of profit and loss and other comprehensive income, you only have this one value for interest income. But if you refer to your note number 1, interest income, you'll see that this interest income consists, for example, interest on fixed deposit, interest on debtors account, and other interest income. Okay, so it just gives us more information on this interest income amount. Okay, so that's our interest income, and then what we also have is our allowance for credit loss adjustment. So remember from a previous video, an allowance for credit losses, that's where we create an estimation or an estimate on what we expect our bad debts will be. Okay, so it's going to be a negative asset, so it will essentially decrease our potential debtors control. Okay, and then our gross profit plus our other income gives us our gross income. Okay, and then from that we need to subtract our distribution, administration, and other expenses. So these are just your general overhead expenses. So your advertising, repairs and maintenance, credit losses, so that's when you write off someone as a bad debt, telephone insurance, allowance for credit loss adjustment. So that's when we make this provision for our credit losses, but it is an increase. So for example, previous year our allowance for credit losses was 5,000 Rand. Now we calculate our allowance for credit losses for the current year and it's now 6,000 Rand. So it's more than what we expected to be. So in other words, logically it will then be an expense to you. So that's why if it's an increase in our allowance for credit loss adjustment, then that will be a expense. If it was a decrease, so it was 5,000 Rand, it's now 4,000 Rand, then it's less than what we expected it to be, so then that will be an income to you. Okay. And then that will then be your total distribution, administration, and other expenses. And if we account for that, then what we get is our profit or loss before finance costs. And finance costs relates to our interest expense. And for interest expense, again, we have a note, a specific note, which summarizes all the different interest expenses which we had to incur. So that's, for example, your interest on mortgage loan, your interest on creditors account, and other interest expenses. Okay. So that's our interest expense, and if we take our profit before finance costs less our interest expense, then we are left with our total comprehensive income for the year, or our profit for the year. Okay, so that's in a nutshell how our statement of profit and loss and other comprehensive income looks using the perpetual inventory system. Okay, so it's important for you to know and understand this format and where we get this information. Now, our perpetual inventory system, we know we have a cost of sales and we can only determine our cost. Well, we continuously update our cost of sales relating to our inventory, which was bought or sold or whatever. Okay, but with the periodic inventory system, we now, instead of having a cost of sales, we now have to determine our cost of sales. So if you look at our statement of profit and loss and other comprehensive income, for using the periodic inventory system. Then we begin with our revenue. So revenue remains the same: sales less sale returns less settlement discount granted. But now we've got a cost of sales, and cost of sales consists of these components. Okay, to determine your cost of sales, you're going to take your opening inventory balance. You're going to add your purchases in buying new inventory to sell, to trade, and then we'll also adjust that for any purchase returns and settlement discount received, specifically relating to trading inventory. You will add any directly attributable cost in getting these purchases ready or to your premises. So that's, for example, your delivery costs. So your carriage, railage, and freight on purchases. If there's any taxes, so import tariffs, custom duties, all of that you will then add as a cost. And then finally you will subtract your closing inventory. And then that will then be your cost of sales for the year. Okay, so that in essence is the only difference between the perpetual and the periodic inventory system. So in a periodic inventory system, you will just need to determine your cost of sales. Everything else is more or less the same in our statement of profit and loss and other comprehensive income. Okay, so our next financial statement is our statement of financial position. And this is used to assess the solvency of a company. So you want to know whether your assets is more than your liabilities. Okay, and how the format looks is essentially just a summary of your accounting equation. So we've got your total assets, and your total assets equals your equity plus your liabilities. So total assets should be, that amount should be exactly the same as your equity plus liabilities. And that's essentially what your accounting equation states. Okay, so this statement gives a financial position at any point in time, and it changes every time as expenses are incurred or income earned. So it's a statement form of the post-closing trial balance. So you look at the format. We've got our assets. Assets is divided into non-current, so long-term assets, and our current assets, short-term, less than 12 months. So in our long-term assets, we have our property, plant, and equipment, and available for sale financial asset. And both of these has their own note to the financial statements. So property, plant, and equipment, you've got your fixed assets being land and buildings, motor vehicles, furniture and equipment. So land and buildings does not actually accumulate depreciation, because most commonly your land and buildings will always increase in value. So there won't be a depreciation for land and buildings. Okay, we will only revalue our land and buildings. But if you look at it, we've got our fixed assets, our vehicles, furniture, equipment, machinery, and the format is you start with your carrying value as at the beginning of the year, and your carrying value is your cost price less accumulated depreciation. You've got your movements during the year, so that's any additions, and this additions should always be as at the cost price. You've got your disposables, and this disposables is always as at the carrying value. Okay, and then your depreciation for the year. And then what you also have is and then that will determine your carrying value as at the end of the year. So it's going to be your cost price less your accumulated depreciation as at the end of the year. So that's your property, plant, and equipment note. Our available for sale financial assets. So this is only your long-term investments. So most commonly in this course, it will only be your investment in a fixed deposit, a long-term fixed deposit. Okay. So those are our non-current assets, our long-term assets. Then if you have our current assets, we've got inventory, trade and other receivables, and then cash and cash equivalent. So inventory, we've got our So with inventory, you always start with your trading inventory, and that's your closing balance of your inventory. So that's when you do a stock take on the last day of the financial year, that will be the value which you use. Okay, and then you've got your consumable stores on hand, and that's for stationery, cleaning material, or consumable goods. So that's in essence, during the year you buy stationery or cleaning material, and you you accounted for that expense, but it does happen that you don't always use all your stationery for the year. You still have some stationery left which you can take to the next financial year, and that's where we will then account for. We will take out that stationery or cleaning material or consumable goods value, and we'll just take it to the next financial year. Okay, and then our trade and other receivables. For that, we've got your trade debtors, so people who bought on you on credit. We need to adjust it for our allowance for credit losses. We're going to adjust it for our allowance for settlement discount granted, and then that will give you your net trade debtors. And then also added to our trade and other receivables will be your accrued income items and your prepaid expense items. And finally, if there's any deposit, then you'll also add that to your trade and other receivables. And then your final current asset is going to be cash and cash equivalent, and that's essentially your money which you have. So that's your savings account, your money market account, bank, petty cash, cash float. So just a sum of all the cash which you have. Okay. So that is our total assets. If we look at our equity and liabilities portion, equity, for that we will have a look at our statement of change in equity. And equity basically refers to your capital plus your net profit and losses minus drawings. So how the format looks is we've got our capital balance as at the beginning of the year. We need to add any additional contributions, so any additional capital contributions made during the year. We're going to add our profit or subtract if we made a loss for the year, and we're going to subtract our drawings for the year, and that will then be our capital balance as at the end of the year, and it will then be our equity as at the end of the year. Okay, and in our liabilities, that's also divided into non-current, long-term liabilities, and current liabilities. Our non-current liabilities is your mortgage loan and long-term loans, whereas our current liabilities is a trade and other payables or a bank overdraft. So if we owe the bank money, we drew more money than what we had in our bank account. We look at the notes. So our long-term borrowings is your mortgage loan and long-term loans, whereas your trade and other payables is going to be your trade creditors, plus then your accrued expenses and income received in advance, and anything which you owe to SARS. So if you have a liability towards SARS. So that's basically in a nutshell your financial statement formats, and you need to know and understand all of these formats. By just writing down these formats, you will get quite a lot of marks. So it's your best guide in answering these type of questions. So getting to that, let's have a look at a question. So if we have a look here at question 10.4, that's what we have is we have the pre-adjusted trial balance in the books of JPEG Enterprises as at the end of their second financial year. So what I'm going to do now is I'm going to do two comprehensive questions. It will be this question 10.4, which will be a question using the perpetual inventory system, and then we'll do another question which will be on the periodic inventory system. Okay, so looking at JPEG Enterprises, we've got our pre-adjusted trial balance as at the 28th of Feb 2005. So that's basically the last day of our financial year. So the first thing that you always do is you need to draw your timeline. So in our financial year is from the 1st of March 2004 and it ends on the 28th of Feb 2005. So what were our balances? So we had our capital drawings, our other assets and liability accounts. We've got our nominal accounts, which is your income and sales. And you can see here that your debit and credit does equal. Okay, so that's your double entry system. For every transaction, there is a debit and a credit side. Okay, so what is required from us? So firstly, we need to journalize the adjustments within our general journal. We need to prepare our statement of profit and loss and other comprehensive income for the year ending 28th of February 2005. We're going to draft our statement of financial position. We will draft our statement of change in equity, and we'll prepare the notes to the financial statement as at the 28th of February 2005. So what information do we have? Let's start off. So first it says, provide for depreciation as follow. On vehicles, 25% on cost. Note that a new vehicle costing 360,000 Rand was bought on the 1st of November 2004. Okay, so let's go to our timeline and write this down. So firstly, at the end of the financial year, our vehicles had a balance of 680,000 Rand. Okay, and at the beginning of the year, our vehicles had a accumulated depreciation of 88,000 Rand. So that was on the 1st of March 2008. So during the year, we went and we bought an additional vehicle. For 360,000 Rand, and that was on the 1st of November 2005. And we depreciate at 25% on cost. So on the 1st of June, so that will be there, we went and we bought an additional vehicle for 360,000 Rand. So what is that we need to do? So firstly, we want to determine what is our depreciation for the year. And in our depreciation, we use the cost price method. So in other words, the straight line method. In a straight line method of depreciation, you only take your original cost price of your asset and you depreciate it at the rate which it gives. In this instance, it's going to be 25%. But how are we going to, what will be our value for our vehicles? Okay, so firstly, what we need to do is we need to depreciate this new vehicle we bought for the period the 1st of June 2004 up until the period 28th of Feb 2005. So in other words, for 9 out of 12 months. So for 9 out of 12 months. So if we have a look at it, we're going to take our cost price. So our calculation will then be 360,000 Rand, that's our cost price, multiply by our depreciation rate of 25%, and multiply by the number of months in which we held this vehicle. So for 9 out of 12 months. So if we get that depreciation rate, then it will be 67,000 so let's just put this here. Okay, so our depreciation on this new vehicle which we bought is 67,000 Rand for the year. Okay, but if we look at it, so that's our new vehicle. but we also need to account for these older vehicles that we have. And in our older vehicles, at the end of the year, our balance towards these vehicles is 680,000 Rand. So that's all our vehicles, the cost price of all our vehicles on the last day of the financial year, being the 28th of Feb 2005. But we know that we bought this additional vehicle of 360,000 Rand at the beginning on the 1st of June 2004. So we know that 360,000 Rand is included in the 680,000 Rand. Now we already calculated depreciation on this new vehicle. So what we need to do is we need to take the 360,000 Rand out of the 680,000 Rand, and on that we will then depreciate our vehicles. So we want to know our balance towards vehicles at the beginning of the financial year. So if at the end of the financial year our balance towards vehicles was 680,000 Rand and we bought a new vehicle, then our cost price will then be 680,000 Rand less this new vehicle which we bought for the year, so less 360,000 Rand. So our cost price is then less 360,000 Rand. So our cost price is 320,000 Rand. So that is our cost price of our vehicles at the beginning of the financial year. Okay, and then that we will then have to depreciate for the year. So we're going to take our cost price of 320,000 Rand. We're going to depreciate it at the rate of 25%, and this older vehicles we held from the 1st of March 2004 up until the 28th of Feb. So we held it for 12 out of 12 months. And if you do this calculation, then our depreciation on this older vehicles is going to be, sorry, that's 320, going to be 80,000 Rand. So at the end of the year, our total depreciation is then the 80,000 Rand on the older vehicles plus then the 67,500 Rand on the new vehicles. So that will then be 147,500. So what is depreciation to you? Depreciation is an expense. So if it's an expense, then we know, and it increases, then we know we will debit our expense account. So in this example, we will then we will debit our depreciation of 147,500 Rand, and we're going to credit our accumulated depreciation on vehicles account, which is the loss in value of our asset. So we'll credit 147,500 Rand. So in this example, what I did is I just added the depreciation for vehicles and furniture together, okay, to get our total depreciation. So let's have a look at what is how we account for our depreciation in terms of furniture. So what do we have here? So it says here that we on furniture we depreciate at a rate of 16 2/3% per annum according to the reducing balance method. Importantly is we need to take into account that a new office desk was bought for 8,400 Rand on the 1st of September 2004. So let's write this in our timeline. So our balance towards furniture at the end of the financial year is 145,600 Rand, and our accumulated depreciation on furniture is 25,600 Rand. And this accumulated depreciation is as per the 1st of March. So if we record this information, we've got our cost price, and our cost price on the 28th of Feb 2005 towards furniture was 145,600, and we have our accumulated depreciation, and this accumulated depreciation is as per the 1st of March, the beginning of our financial year, and that was on furniture 25,600 Rand. Okay. Then during the year, we went and we bought an additional desk, and we bought this on the 1st of September 2004. The 1st of September, we bought an additional desk which has a cost price of 8,400 Rand. So what is it that we need to do? We need to look at this new desk which we bought, and we're going to depreciate that desk for the period 1st of September 2004 up until the 28th of Feb 2005. And then we also need to look at our older furniture, and we need to depreciate that older furniture for the period 1st of March 2004 up until the 20th of Feb 2005, so for 12 months. Okay, so let's start off simple and we calculate the depreciation on the new desk which we bought. So we bought this new desk, we bought it for 8,400 Rand. So that we depreciate at a rate of 16.667, so 2/3%, and that we need to just have a few sixes in here, so 66666.7, and then that we will then depreciate at a rate, so then that we held for 6 out of 12 months. So if we do this calculation, then our depreciation will then be 8,400 Rand multiplied by 0.1 multiplied by 6 out of 12 months. So our depreciation on this new desk which we bought for the period 1st of September up until the 20th of Feb is 700 Rand. Now let's look at our older furniture. So our older furniture, the first we need to do is we need to determine our cost price on this older furniture, because this 145,600 Rand, that is our cost price as at the end of the year, and that includes this 8,400 Rand which we separated, and we calculated depreciation on that separately. So what we need to do is we need to take out this 8,400 Rand, and that will then be what is remaining. That will be the accumulated depreciation on that. Okay, so to do that, we get our cost price. Our cost price is the value at the end of the year of 145,600 Rand minus the 8,400 Rand, which we take out. So then our cost price equals 137,200. Our accumulated depreciation on this cost price as per the beginning of the year is 25,600. Let's put it in brackets to say it's negative. Okay. And then what are we using? We're using the diminishing balance method for depreciation. So that means we need to calculate our carrying value. And your carrying value is your cost price less your accumulated depreciation. Let me just do this, sorry. So we're going to say here our cost price of 137,200 Rand less than 25,600 Rand. So our carrying value is 111,600 Rand. Now this carrying value we will use to calculate the depreciation for the full 12 out of 12 months. So our calculation will then be at the end of the year, it will be our carrying value of 111,600 Rand multiplied by 16.66666667% multiplied by 12 out of 12 months. So let's just delete that. Okay, so if we do this calculation, let's say here that multiplied by 60 multiplied by 12 out of 12. So our depreciation at the end of the year towards this older furniture is 18,600 Rand, plus then our 700 Rand for the new desk which we bought. So if we account for this, then our total depreciation towards furniture will then be 19,300 Rand. So we will debit our depreciation account and we're going to credit our accumulated depreciation on furniture account. Okay, so that's looking at our depreciation. The next thing what we have is the owner. He took inventory for personal use on the 26th of Feb 2005. The selling price of this inventory was 1,600 Rand, and we use a markup of 33.33% on cost price. This transaction must still be processed. So what did we do here? So here we have the owner, and because he's the owner, he's entitled to make drawings. So he's entitled to take anything, in this case inventory, for personal use. So he took this inventory on the 26th of February, but we still haven't recorded this transaction. So we need to record this transaction in our general journal, and we also have to post it to the relevant financial statements and adjust our accounts accordingly. But what did he do? The owner, he went and he took inventory. The inventory has a selling price of 1,600 Rand, but the owner didn't physically buy this inventory. He just took the cost price of the inventory. So we will have to we would need to take the selling price of 1,600 Rand, and we will need to determine what was the cost price, because that's essentially the loss which we made in the owner making drawings. Okay, and we determine our cost price by using a markup of 33.33% on cost price. So if we look at it, we've got the owner, we've got a selling price of 1,600 Rand. We need to multiply that in order to get the cost price. We're going to multiply that by 100 and then divide by 133 and a third and 0.33333. So the value, the cost price of this inventory is 1,200 Rand. So what did the owner do? He made drawings. Drawings, we know, increases on the debit side. So our drawings, we will then debit 1,200 Rand, and we're going to credit our trading inventory being our asset, and our asset is now decreasing because we had this inventory and now the owner took it for personal use, so we don't have that inventory anymore to sell. So that's a decrease in our asset, so that's why we're going to credit our trading inventory 1,200 Rand. Okay, the next account is, or the next adjustment is a debtor. Ms. F. Tumele has been declared insolvent. We receive a check for 6,000 Rand, and this 6,000 Rand constitutes 30 cents in the Rand from her insolvent estate. This transaction must still be recorded, and what we're going to do is we're going to write the rest of the debt as irrecoverable. So, what information do we have? We've got a debtor, and unfortunately this debtor has been declared insolvent. So she owes us money, but she can't pay us back anymore. Luckily, we receive a portion of what she owes us, and we receive a check of 6,000 Rand. But this 6,000 Rand only represents 30 cents for every 1 Rand which she owes us. So it only represents 30% of what she owes us. So we need to record this money which we received, the 6,000 Rand, because we have not recorded this transaction yet, because it says that this transaction must still be recorded. And then what we need to do is the rest of her debt we need to write off as irrecoverable. So if we receive 30 cents, then 70 cents will then be what we will need to write off. So if we look at it, firstly we receive 6,000 Rand. So we receive that cash, so our bank account being an asset will increase. So our bank account, we will then debit 6,000 Rand because that increased. We received money in our bank account. But now we've got Miss F. Tumele. She is a debtor to us and she owed us a certain amount of money, but now we received a portion of what she owes us. So our debtors will decrease because she owed us an amount, but now it decreased by 6,000 Rand. And debtors control is an asset to you, and if an asset decreases, then you will credit it. So we're going to credit 6,000 Rand, and this 6,000 Rand represents 30 cents for each 1 Rand which Miss F. Tumele owes us. Okay, so that's the one portion of that statement. The next portion is we need to now write the rest of the debt off as irrecoverable. So how do we do that? So first thing we want to determine what does she owe us. Okay, in total. So in total we received 6,000 Rand, but we know that we are still owed 70% or 70 cents. So we're going to take the 6,000 Rand and we're going to multiply it by what she owes us, 70, and we're going to divide by what do we have or what did we receive. So divide by 30. So then we know that she still owes us 14,000 Rand, and that 14,000 Rand we will have to unfortunately write off. And if you write off any bad debt, then that will be a credit loss to you. And a credit loss, we discussed earlier, is an expense to you. And expenses increases on the debit side. So our credit losses, we will then debit 14,000 Rand. And then Ms. F. Tumele, we're going to write her off. So what she owes us, this 14,000 Rand, she doesn't owe us anymore because we're writing her off. So our debtors control will then decrease by 14,000 Rand, which we will then credit. Okay. So next what we have is we now need to look at our allowance for credit losses, and that allowance for credit losses we need to adjust to 5,200 Rand. So what was our allowance for credit losses? At the beginning of the year, or the end of our previous financial year, our allowance for credit losses was 5,400 Rand. Okay, so that's our allowance for credit losses on the 1st of March 2004, which is the beginning of our financial year. But now what are we saying is we want to take this 5,400 Rand and we need to adjust it to 5,200 Rand. So our allowance for credit losses essentially decreased. Okay, so it's less than what we expected it to be. And if it's a downward adjustment for your allowance for credit losses, then that means that downward adjustment will then be an income to you. So it was 5,400 Rand, it's now 5,200 Rand. So then it's a downward adjustment of 200 Rand. Okay, and then that 200 Rand will then be an income to you. So if we record that, we know that income increases on the credit side. So our allowance for credit loss adjustment, remember the adjustment represents whether the income or the expense account. So our allowance for credit loss adjustment, our income increases by 200 Rand. So we're going to credit that. And then our allowance for credit losses, being our negative asset, will now also increase now by, well, it would decrease. It would decrease by 200 Rand from 5,400 Rand to 5,200 Rand, and it's a decrease because it's a negative asset. So that's why we're going to debit our asset account. Okay, so that's looking at our allowance for credit losses. If we look at the second portion, so here they say here that we also want to adjust our allowance for settlement discount granted to 2,470. So what was our allowance for settlement discount granted? On the 1st of May, on the 1st of March 2004, it was 2,400 Rand. Now we want to adjust this 2,400 Rand to 2,470. So it's an upward adjustment. So it's more than what we expected it to be. So in other words, it will be an expense to you. And this expense will then be 70 Rand because it's an upward adjustment from 2,400 Rand to 2,470 Rand. So if it's an expense, then we know we will credit that expense. So we're going to credit our allowance for settlement discount granted adjustment, that's going to be our expense account, and then our allowance for credit loss adjustment, that will then decrease in value. Sorry, our allowance for settlement discount granted will then decrease our asset, so we will credit that. Okay, so then the next one, and this is actually a quite tricky one, is our mortgage bond. Okay, so let's read this statement and then fill in all the information that we have. So firstly, we've got a mortgage bond and was registered on the 1st of March 2004. So in other words, the beginning of our financial year. The initial interest was set at 12% per annum, but this interest was raised to 13% on the 1st of September 2004. The mortgage loan is redeemable in quarterly installments of 48,000 Rand, starting on the 1st of June 2004. All due statements were paid as scheduled, being on the 1st of June 2004, the 1st of September, and the 1st of December 2004. So what we need to do is we want to calculate what should be our interest expense for the year relating to our mortgage loan. And we need to compare that to what we actually paid in terms of our interest on our mortgage loan. And we want to see whether there was any accrued expenses or prepaid expenses. Okay, so let's start by writing down our information. So at the end of the financial year, so the 20th of February 2005, our balance towards our mortgage loan at Festive Bank was 856,000 Rand. If we go to our financial year, our balance was 856,000 Rand. So 856,000 Rand. Okay, so that's our balance. What happened during the year? Well, firstly, we went and the mortgage bond was registered on the 1st of March 2004, so beginning of the financial year. Our interest was initially 12% per year, but this interest was raised to 13% on the 1st of September 2004. So if we look at our timeline, from the period 1 March 2000 and from the period the 1st of March 2004 up until the 31st of August 2004, the interest was, let's do it like that. So the 1st of March 2004 up until the 31st of August, our interest was 12% for this period. Let's merge this and we say it's going to be 12%. That was our interest liability. Now, on the 1st of September 2004, our interest rate was increased to 13%. Let's make this a different color. So we went and we raised our interest to 13%. And this is the interest that we had to pay on our mortgage loan from the 1st of September up until the end of the financial year, being the 20th of Feb. Okay. So we have to have a look at that. Then what we also had during the year is we went and the mortgage loan is redeemable in quarterly installments of 48,000 Rand. We made a 48,000 Rand payment, so we paid off 48,000 Rand from our loan on the 1st of June, on the 1st of September, and on the 1st of December. Okay, so on the 1st of June, we went and we paid off 48,000 Rand. £48,000. On the 1st of September, we paid off 48,000 Rand. So our loan decreased by 48,000 Rand. And then again, on the 1st of December, our loan amount decreased by 48,000 Rand to eventually get to a balance of 856,000 Rand. So we had a balance. Our balance we do not know yet, but that balance, on the 1st of June, we paid off 48,000 Rand from that balance. On the 1st of September, we paid off 48,000 Rand, and then on the 1st of December, we paid off an additional 48,000 Rand. To get to, at the end of the financial year, our balance was 856,000 Rand. So in other words, to get to our balance at the beginning of the year, we will say here, our balance at the end of the year, plus then the 48,000 Rand on which we paid off on the 1st of December, plus the 48,000 Rand of which we paid off on the 1st of September, plus then the 48,000 Rand of which we paid off on the 1st of June 2004. No, I don't know why it doesn't want to calculate this. Oh, I know why. So this should be, it's going to be our 856,000 Rand plus then the 48. So on the beginning of March, our loan amount was R1,000,000. So what is it that we need to do? We need to look at the period from the 1st of March up until the 1st of May. So during this period. And during this period, our loan amount was R1,000,000. This R1,000,000 we need to pay interest of 12%. So we're going to multiply that R1,000,000 by 12%, and then we're going to look at the period from the 1st of March up until the 31st of May. So for 3 out of 12 months, we're going to determine what is our interest on that. So 3 out of 12 months. Okay, and if we do this calculation, then our interest is then 30,000 Rand. So that's for the period from the 1st of March up until the 31st of June. Now our balance decreased from R1,000,000 Rand, and we paid off 48,000 Rand. So it's then going to be equals R1,000,000 Rand less than 48,000 Rand. So our balance now is 952,000 Rand. Okay, and this 952,000 Rand, we're going to now calculate the interest expense during that period from the 1st of June 2004, because that's now a new balance. It's not R1,000,000 Rand, it's now a new balance of 952,000 Rand up until the 31st of August. And that's going to be as at a rate of 12%. So we're going to say 952,000 Rand multiplied by our interest expense of 12% multiplied by 3 out of 12 months. So if we do this calculation, multiply by 12%, multiply by 3 out of 12. So our interest for this period is 28,560. So now let's have a look at the period from the 1st of September up until the 30th of November. So in this period, let's make this nice bright blue. So in this period, what was our balance? So our balance is then going to be this 952,000 Rand less than the payment of 48,000 Rand, which we paid off on the 1st of September. So now our balance is 904,000 Rand. So if we look at this 904,000 Rand, we're going to calculate interest, but now our interest rate also increased from 12% to 13%. So multiply by 13%, multiply that then by 3 out of 12 months, being the 1st of September up until the 30th of November. Okay, and if you do this calculation, we get then an interest for this period of 29,380. Okay, and finally, if we look at the final 3 months, In the final 3 months, what will be our balance? So our balance is now going to be the 904,000 Rand from the 1st of September, less than this 48,000 Rand, which we paid off. So it's now 856,000 Rand. And that we will have to pay interest at a rate of 13% for 3 out of 12 months. Okay, so our interest is then 856,000 Rand multiplied by 0.13 multiplied by 3 out of 12 months. So it's going to be 27,850. So at the end of the financial period, our total interest expense on what we should have paid is 760. In actual fact, what did we pay? We only paid, we go to our expenses, our interest expense, interest on mortgage loan, we only paid 106,486. So we still need to make a payment. So our liability is 150,760, but we only made a payment of 106,486. So we still owe 9,274. So our interest expense has to increase by 9,274. And what will this be? We owe the bank still money, so it's going to be an accrued expense, a current liability to us. So if we record this, we said there that our expenses needs to increase, and we know that expenses increases on the debit side. So our interest on mortgage loan expense has to increase, so we're going to debit 9,274 Rand, and we have to credit our accrued expenses, which is our liability, and our liabilities increases, so we will credit 9,274. Okay, so with this interest, it's quite complex, and you have to. The most important thing here is you have to draw your timeline, and you need to know when there was a payment made, what effect does it have on your balance, is there any change in interest rate, and at every period when there is a change, you need to calculate the interest during that period. So just break down your financial year into the different periods. Okay. So next, what do we have? We have the tenant. He moved into the building on the 1st of September 2003, and the rental for March 2005 has been prepaid. So we earn a rental income from this guy, and he went and he prepaid his rent for the next for the March 2005, and that March relates to the next financial year. So it's a prepaid income which we received. So in total, our income for rental income is 107,250. So he moved in, he paid for the full 12 months during the current financial year, plus then an additional month, being for March 2005. So he paid for 13 months. So his rental payment per month is 8,250. Now rental income has to now decrease by that 8,250 because it does not relate to the current financial year. We only want to deal with all those accounts which relates to the current financial year. So we need to take out anything which does not relate to the current financial year, or we need to add anything that still needs to be added to the current financial year. In this instance, we're going to take out our income. So our income has to decrease by 8,250 Rand. So we will debit our rental income account, and then we're going to credit our income received in advance, which is a liability to you. And liabilities increases on the credit side. Okay, so next we have our quarterly statement of the fixed deposit, shows accrued interest of 200 Rand. Fixed deposit matures on the 1st of September 2005. So in this instance, we went and we have our fixed deposit and it earns interest, but we still need to receive a 200 Rand interest on this fixed deposit. So our income has to increase, and if your income increases, then you know it's going to be a credit. So we're going to credit our interest on fixed deposit 200 Rand, and we will debit our accrued income account 200 Rand, because this accrued income relates to the bank or whoever who owes you that money. So it's a current asset to you. Okay. Okay, and then the next one is the amount for advertising includes an amount of 17,000 Rand for advertisements which will be broadcast over the radio during the period 13 March 2005 up until the 21st of April 2005. So that's again relates to the next financial year, March and April, and then next financial year. So we made this expense, but we need to take it out from our advertising expenses. So our expenses has to decrease. And if your expenses decreases, then you will credit your expenses. So we're going to credit 17,000 Rand in terms of advertising. So our advertising has to decrease by 17,000 Rand. And we're going to debit our prepaid expenses, being our current asset increasing 17,000 Rand. Okay. And then the final account is we went and we did a stock take at the end of the year, and we found that our trading inventory was 42,400 Rand. So let's look at that trading inventory. So our balance in terms of trading inventory, according to our books, is 44,700 Rand. Okay, but we did a stock take, and we found it to be 42,400 Rand. So there's a difference. So let's look at that difference firstly. So our balance, according to our pre-adjusted trial balance, is 44,700 Rand. We need to subtract this 2,200 Rand drawings from our inventory, because we still need to record that, and our inventory decreased by that. So if we say 44,700 Rand less 1,200 Rand, then we know that our inventory balance, according to our trial balance, is 43,500 Rand. But we did a physical stock take, so we counted all the number of inventory we have, and we only found it to be 42,400 Rand. So there's a difference of 1,100 Rand, and that difference is essentially, for example, stolen goods, obsolete goods, stuff we had to write off, anything like that. So our trading inventory has to decrease by 1,100 Rand. So our asset decreases, so we will credit our trading inventory account, and then our cost of sales, being our expense account, has to increase. So we're going to debit 1,100 Rand in terms of cost of sales. Okay. Because we need to take into account for this loss in inventory. And then finally, we have our consumable stores of 1,040 and our stationery of 600 Rand. So this is still stationery and consumable stores that we can use in the next financial year. So in other words, if we look at it, our expenses towards stationery was 7,600 Rand, but 600 Rand of that we can still use in the next financial year. So we're going to take out 600 Rand and we're going to take it to the next financial year. The same with our consumable stores. Where is that? So consumable stores was 8,440 Rand, but 1,040 Rand we still have left, and which we can take to our next financial year. So we need to decrease these expenses. And if we decrease an expense, you will credit that expense account. So we're going to credit our stationery account 600 Rand, and we're going to credit our consumable stores 1,040 Rand. So in total, we will then debit our asset, being our consumable stores on hand account, which increases. Okay, so that's looking at all of these adjustments and how we account for it in our general journal. Next, what we need to do is we now need to take this information and we need to input it within our financial statements. So let's start with our statement of profit and loss and other comprehensive income. So always start with your heading. So we've got JPEG Enterprises. We're looking at the statement of profit and loss and other comprehensive income, and this is for the year ending 28th of Feb 2005. So that's an easy 1 to 2 marks that you always need to get. Then you need to write down your format. This statement has a fixed format, and if you write it down, then it will be easy for you to then just slot in the values wherever it relates to. So we start off with our revenue. Sorry, this should be revenue. And our revenue is our sales, less our sale returns, less our settlement discount granted. So what is our sales? So our sales for the year was 1.5 million Rand. Less our sale returns of 2,220 Rand. Less than our settlement discount granted, which is 2,296 Rand. And then we also need to adjust for this allowance for settlement discount granted. So this allowance was an expense, so it was a upward adjustment. So in other words, we will also need to subtract the 70 Rand. Okay, so it's our sales of 1,500 Rand less our sale returns of 2,220 Rand, less than your settlement discount granted, your actual settlement discount granted, and then less the provision or allowance for settlement discount granted adjustment. Okay, that gives us a total revenue of 1,495,414 Rand. Next, we have our cost of sales, and our cost of sales will then be our so we've got our cost of sales less our settlement discount received. So our cost of sales was 1,125,000 Rand. We're going to subtract the settlement discount which we received on this cost of sales of 4,080 Rand. And we also need to account for, remember what we did here, we went and we debited our cost of sales. So our cost of sales expense has to increase. So we need to add this 1,100 Rand to our cost of sales. So we've got our cost of sales of 1,125,000 Rand plus then the 1,100 Rand of stolen goods, by which our cost of sales has to increase that expense, less our settlement discount granted of 4,080 Rand. Gives us a total cost of sales of 1,122,020 Rand. And then if you take our revenue less cost of sales, then we've got a gross profit of 337,000 Rand, 373,000 Rand, 394. If we look at what our other income was, so let's start with our trial balance, so our other income was rental income of 107,250. It was our credit losses that recovered of 1,000 Rand, our settlement discount received, but we already accounted for that, and then our interest income of 14,366 and our interest on fixed deposit. Okay, so our rental income, we said, was 107,250. But remember, we had this rental income where the lady or the tenant prepaid for the next financial year. So we received this 8,250 Rand, but it does not relate to our current financial year. So we need to take that out. So our rental income has to decrease by 8,250 Rand. So in actual fact, our rental income, which relates to the current financial year, is only 99,000 Rand. Next, we had our credit losses recovered, and that was just 1,000 Rand, which we recovered during the current financial year. Then our interest income. For interest income, we're going to have a look at note number 1. So in our note number 1, we had our interest from investments of 2,200 Rand, so that's your fixed deposit, and yet you had an interest income of 14,366. But our fixed deposit, remember, we went and we had an accrued income of 200 Rand. So if we go to this one, our interest on fixed deposit, we still need to receive 200 Rand on this fixed deposit. So our income has to increase by 200 Rand. So if you add that, then your total interest from investments is 2,400 Rand, and plus then your 14,366 gives you a total interest income of 16,766 Rand. Okay. So we're going to record that 16,766. And finally, remember we had this allowance for settlement discount granted for settlement. Our allowance for credit losses, and this was a downward adjustment, so that was an income to you. And if it's an income, then our income increased by 200 Rand. So we're going to add our allowance for credit loss adjustment income 200 Rand. So in total, our other income was amounted to 116,966. If we add that to our gross profit, then we have a gross income of 490,366. Now we need to account for our distribution, administration, and other expenses. So what were our other expenses? So you just need to look at your trial balance. You need to input the values, and then if there's any adjustments, you need to make adjustments. So we had salary and wages of 228,000 Rand. We had advertising of 24,000 Rand. So we had stationery of 7,600 Rand, consumable stores, insurance, credit losses, interest expense. So let's look at our advertising. So our advertising was 24,000 Rand. But we know there that in our advertising, we went and we prepaid for the next financial year. So for March and April, we prepaid 17,000 Rand. So our advertising of 24,000 Rand has to decrease by 17,000 Rand, because that 17,000 Rand does not relate to the current financial year. So our actual advertising expense was only 7,000 Rand. If we look at our stationery, so stationery, our expense was 7,600 Rand, but remember we had the 600 Rand which we can still take to the next financial year, so we didn't use this stationery. So we're going to take our expense of 7,600 Rand less than 600 Rand into giving you a total stationery which we used and bought for the current financial year of 7,000 Rand. The same for consumable stores. So your balance was 8,440 less than the 1,040 which we did not use. Okay. And then we had our salaries and wages of 228,000 Rand. We don't make any other adjustments to that. Our insurance of 70,760 and our credit losses of 25,600 Rand. So our insurance 70,760, our wages and salaries 228,000 Rand, and our credit losses was 25,600 Rand. We need to add to that Miss F to Melee, which we had to write off the 14,000 Rand which we still owed us. We only received 6,000 Rand, but she still owed us 14,000 Rand, and she was declared insolvent, so she couldn't pay us that back. Okay, so we wrote it off as a credit loss. So our total credit losses increase to 39,600 Rand. Our other expenses that we have, interest we deal with separately, so we'll get back to that. We've got bank charges of 2,184 Rand, and our general expenses of 29,614. And then what we also have is our depreciation for the year. So our total depreciation for the year expense was 166,800 Rand. If we account for it, our bank charges 2,184 Rand, our general expenses 29,614, and our depreciation 166,800 Rand. So our total expenses was 558,358. If we take our gross income less our distribution, administration, and other expenses, then we made a loss before our finance cost of 67,998 Rand. Okay. Now, finally, what we need to do is we need to look at our interest expense, and for that, we will look at note number 2. So, what was our interest expense? Our interest expense was our interest expense on credit account of 6,780 Rand, our interest on overdraft of 1,102 Rand, and our interest on mortgage loan of 106,486 Rand. But with our interest on mortgage loan, remember we underpaid. We still needed to pay. That expense still needs to increase by 9,274. So if we go to note number 2, our interest on overdraft is 1,102 Rand. Our interest on expense is 6,780 Rand. Our interest on mortgage loan is then, our balance is 106,486. That had to increase by the 9,274 Rand to get to an actual interest expense of 115,760. Okay, so our total interest expense was 123,642. So we made a total comprehensive loss for the year of 191,640 Rand. Okay, if we have a look at our statement of financial position, what do we have? We've got our assets, and our assets that's divided into our non-current assets, our property, plant, and equipment. So in our property, plant, and equipment, what do we have? We've got our land and buildings, vehicles, and furniture. So if we get our balances, so in our statement of pre-adjusted trial balance, we've got a closing balance towards land and buildings of R1,000,000, towards vehicles of 680,000 Rand, and 145,600 Rand towards furniture. So that's your cost price as at the end of the year. Your cumulative depreciation at the beginning of the year for vehicles was 88,000 Rand, and for furniture it was 25,600 Rand. So if we record that, we said there that our closing cost price for land and buildings was R1,000,000. For vehicles, it's 688,000 Rand. And for furniture is 145,600 Rand. So in total, it's 1,825,600 Rand. For vehicles, our opening accumulated depreciation was 88,000 Rand. And for furniture, it was 25,600 Rand. What movements happened during the year? So, firstly, we bought a new vehicle of 360,000 Rand and we bought a new desk or furniture of 8,400 Rand. So let's record those cost price. So our additions as at the cost price for vehicles were 360,000 Rand and for furniture it was 8,400 Rand. The next thing what we need to do is we need to record what our depreciation was for this. So for vehicles it was 147,500 Rand and for furniture it was 19,300 Rand. Okay, so our depreciation will then decrease. So it's going to be negative 147,500 Rand and negative 19,300 Rand. So what we need to do now is we need to now fill in all the blanks. So our land and buildings, there was no other movement during the year. We've got a cost price of R1,000,000. It does not accumulate any depreciation. So our carrying value as at the end of the year is R1,000,000. That will also be our cost price and carry value as at the beginning of the year because there weren't any movements during the year. Towards our vehicles, what do we have? So we currently have a cost price of 680,000 Rand. Plus we bought an additional vehicle of 360,000 Rand. So our cost price at the beginning of the year was then 320,000 Rand. Because this 320,000 Rand plus this 360,000 gives us our balance towards vehicles at the end of the year of 680,000 Rand. The same with furniture. So if you do that, then you find that your furniture, your cost price at the beginning of the year is 137,200 Rand. Then to determine our carrying value, we're just going to say our cost price less our accumulated depreciation. So for vehicles, our carrying value at the beginning of the year is 232,000 Rand and for furniture is 111,600 Rand. Finally, the only other thing that we still need to determine is our accumulated depreciation as at the end of the year. So that's going to be our accumulated depreciation at the beginning of the year plus our depreciation for the year of 147,500 Rand. The total accumulated depreciation for vehicles at the end of the year was 235,500 Rand. For furniture, it will be 44,900 Rand. And then you need to determine your carrying value, so your cost price less accumulated depreciation. So for vehicles, our carrying value is 444,500 Rand, and for furniture is 100,700 Rand. So total, our carrying value towards property, plant, and equipment is 1,545,200 Rand, and that we record here as our non-current asset for property, plant, and equipment. Next, we need to record our inventory. So our current asset, so that's going to be our inventory. Our inventory, what we use here is we just use the information we get from our stock take. So for inventory, on the last day of the financial year, we counted our physical inventory to be 42,400 Rand, and our consumable stores will then be 1,040 Rand, and for stationery, so our consumables on hand is those two. Okay, so trading inventory, our balance at the end of the year is 42,400 Rand, and our consumable stores on hand, so what we have left for the next financial year is 600 Rand towards stationery and 1,040 Rand towards consumable stores. So in total, our inventory will then be 44,040 Rand. Then we've got our trade and other receivables. So our balance towards trade and other receivables. So it's 124,000 Rand towards debtors, but we need to subtract from that Miss F to Mele. So the 6,000 Rand which we received from her, and then the 14,000 which we had to write off. So we have to subtract 20,000 Rand from that. Okay, so it's our trade debtors, so our balance according to our trial balance of 124,000 Rand, minus the 6,000 Rand which we received from Ms. Tumele, minus the 14,000 Rand which we had to write off. So in total our trade debtors is 104,000 Rand. We need to subtract our provision for credit losses as well as our allowance for settlement discount granted. And that we determined to be 5,200 Rand for the current financial year and 2,470 Rand for the current financial year. So our net trade debtors is 96,330. We're going to add our accrued income and our prepaid expenses. So our accrued income was only the interest on fixed deposit, so we still need to receive 200 Rand on our interest on fixed deposit. And our prepaid expenses was towards advertising, in which we prepaid for the next financial year. Okay, 17,000 Rand. And finally, if there's any deposit that you will also add to your trade and other receivables. So here we had a deposit for water and electricity of 10,000 Rand. Okay, so that will be our trade and other receivables. Then what will be our cash and cash equivalent? So that will be our petty cash of 4,000 Rand, our cash float of 2,800 Rand, our savings account of 16,000 Rand, and in our bank, will it be our bank account? Well, what is bank to you? Bank is an asset, and assets increases on the debit side. Does our bank has a debit balance? No, it has a credit balance. So that means your bank will be overdrawn. It will be an overdraft. So it's a liability to you. So if we just record our cash and cash equivalent, so it was our savings account of 16,000 Rand, our petty cash of 4,000 Rand, and our cash float of 2,800 Rand. So in total, our cash and cash equivalent was 22,800 Rand. Okay. And then we also had our fixed deposit from Rasta Bank. So total, our current assets was 390,000 Rand, 370, and our non-current assets was 1.5 million and 45,200 Rand. So our total assets is 1,935,570. Getting back to our okay, so then let's have a look at our equity. What is equity? So for equity, we're going to have a look at our statement of changes in equity. So we're going to take our capital balance as at the beginning of the year of 1,180,282. We need to subtract our drawings of 84,900 Rand. And we're going to subtract our loss, which we made for the year of 191,640. And all of this we need to do in our statement of changes in equity. So opening balance was 1,180,282 plus any additional capital contributions. Were there any? No. Plus our profit if we made, or less our loss for the year, and our loss for the year was 191,640, and then less our drawings. So our drawings was 84,900 Rand plus then the 1,200 Rand drawings which we made here, where the owner took for himself, and it having a selling price of 1,600 Rand. Okay. Giving us a total equity at the end of the year of 902,554. Okay, what was our long-term portion? So our liabilities, our non-current liabilities, in other words, our long-term liabilities. So that consists of our mortgage bond of 856,000 Rand. So that's that's the balance in terms of our mortgage bond. But what we know from our mortgage bond is we pay off 48,000 Rand each quarter. So that will be our short-term portion. So if we look at our mortgage bond, and if we look at our note, so our mortgage bond is 856,000 Rand. But we know, from that, we're going to pay in the next financial year, we're going to pay 48,000 Rand on the 1st of June, September, and on the 1st of March, June, September, and December. So that relates to our short-term portion. So it's not our long-term borrowing, so not more than 12 months. All of this is our short-term portion. So we need to take that out from our long-term portion. So our long-term portion in terms of our loan is 664,000 Rand, which we record here. But our current liabilities, our short-term portion on our liabilities, is then going to be that 48,000 Rand for the next year, on the 1st of March, the 1st of June, the 1st of September, and the 1st of December. So the short-term portion of our mortgage loan is then 192,000 Rand. So you need to split your loan into the long-term portion and what is the short-term portion. Okay, and then finally our trade and other payables. So our trade and other payables, that will be our creditors control of 91,344, and it will be what we owe SARS of 47,900 Rand. So if we go to our note, in our note we will have our trade creditors of 91,344. We've got our liability to SARS, and in our accrued expenses, our interest on mortgage loan that we still need to pay in terms of our mortgage interest, and our income received in advance, our rental income which we received in advance. So our total trade and other payables is 156,768. Okay, which we then input here. And then finally, remember we had a credit balance towards bank of 26,260, so that's a liability to you. You owe that money to the bank. What our bank also, we received 6,000 Rand, so then our liability decreased by 6,000 Rand. So in actual fact, from Ms. F to Mele, in actual fact, our liability is only now 20,260. And if we add then our equity and our non-current and current liabilities, then we get a total equity and liabilities of 1,935,570 Rand, and that equals our total assets. So we're happy with our financial statements. So that's basically in a nutshell the full process on your financial statement. So it's quite a lot to take in and it's quite a lot to understand. The most important for you is to know your formats and to understand your formats and how that works. And then just to input the values and look at the calculations and how we determine all of this. Okay, so what we had a look at was a question using the perpetual inventory system. Okay, so now let's have a look at a question using the periodic inventory system. It's going to be very similar to what we just did, so I will go through it relatively quickly. But the only difference is instead of using the perpetual inventory system, now we use the periodic inventory system. So in other words, in our statement of profit and loss and other comprehensive income, there we will determine our cost of sales. We do not have a cost of sales, we will have to calculate that. But let's have a look at what we have. So the following extracts was taken from the books of Axel at the end of the financial year, and the financial year ends on the 31st of March 2006. We've got our balance sheet section, got our nominal account section, which are income and expenses, and then we've got additional information. And then required is we need to journalize all of this in the general journal. We need to prepare our statement of profit and loss and other comprehensive income for the year ending. We need to draft our statement of financial position. We need to draft a statement of change in equity and prepare our notes to our financial statements. So let's have a look. So firstly, we want to provide for depreciation as follows. On furniture and fittings, 15% per annum on cost price. Note that the new furniture and fittings costing $142,356 was bought on the 1st of February 2016. This has been properly recorded. So what do we have? If we have a look here at our furniture and fittings balance, at the end of the year, our balance towards furniture and fittings was $355,754.50. So let's go to our timeline. So in our timeline, we said it's $355,754 and 50 cents. We also know that our accumulated depreciation on furniture and fittings is $53,363 and 15 cents. Okay. So if we record that, our balance in terms of furniture and fittings at the end of the year is $355,754 and 30 cents, and so that's our cost price, and our accumulated depreciation at the beginning of the year was $53,363 and 15 cents. Okay, what happened during the current financial year? Well, we went and we bought additional furniture and fittings to the value of $142,356 rand, and we depreciate furniture and fittings at a rate of 15% on costs. So in other words, the straight line method. And we bought this on the 1st of February 2016. So our cost price increased here by $142,356 to get to 355,000 rand. Okay, so what we need to do is we need to look at this new furniture and fittings for the period 1st of February 2000 so for the period the 1st of February 2016 up until the 31st of March. So for these 2 months, we're going to depreciate this new furniture and fittings, and then we also need to do our older furniture and fittings. So let's start with the new furniture and fittings. New furniture. So in this, our cost price, so our cost price is 142,000. So 142,356. That we depreciate at a rate of 15%, and during the current financial year we had this furniture and fittings only from the 1st of March up until the 31st of only from 1st of Feb up until the 31st of March, so for 2 out of 12 months. So if we calculate our depreciation, then our depreciation is then $3,558.90. if you look at our, so that's on our new furniture. If you look at our older furniture, on that we now need to determine what is our cost price. So our cost price is then going to be this balance as at the end of the year minus this new furniture which we bought, because we went and we separated that and we dealt with that separately to get to the depreciation of that. So we need to separate that from this balance at the end of the year, and on that we're going to depreciate for then 12 out of 12 months. So our cost price is then going to be 355,754 and 30 cents minus this 142,356. So that will then be 213,398 and 50 cents. So that's going to be our cost price. Our depreciation will then be 213,398 and 50 cents multiplied by 15%, multiplied by 12 out of 12 months, because we own it for 12 out of 12 months. So if you do this calculation, then we get a depreciation value of 52,009 Rand and 75 cents. So that's at the end of the financial year. We calculate depreciation at the end of the year. So our total depreciation in terms of furniture and fittings is then going to be the sum of this 3,558 and the 52,000 Rand. So in total our depreciation is going to be 35,568 and 65 cents. So if we record that, then we know that depreciation is an expense, so we're going to debit our expense, 35,568 and 65 cents, and we're going to credit the loss in value of our asset, which decreases by 35,000. So that's our accumulated depreciation on furniture and fittings. Next, what we have is our accumulated our depreciation on equipment, and on that we just depreciate it at 20% per annum on the reducing balance method. What does it mean if we use the reducing balance method? It means we will need to determine our carrying value. Our carrying value is our cost price less accumulated depreciation. So on computer equipment, at the end of the financial year, our balance towards equipment is 371,565 and 60 cents, and our accumulated depreciation is 74,313 and 12 cents. Okay, so if we record that, in our timeline, so our cost price at the end of the year was 371,565 and 60 cents, and our accumulated depreciation at the beginning of the year was 74,313 and 12 cents. So So this cost price, we didn't buy any additional equipment during the year, so then our cost price will at the beginning of the year was then this remained the same at 371,565 and 60 cents. So if we determine our carrying value is going to be our cost price less accumulated depreciation. So it's 371,000 Rand less the 74,000 Rand. And that's going to be 297,000 Rand. And our depreciation will then be this 297,252 and 50 cents multiplied by 20% and then multiply them by 12 out of 12 months. So if we do our calculation, we're going to say here that multiply by 20, multiply by 12, divide by 12. So our depreciation towards equipment is going to be 59,450 and 50 cents. Okay, we know that depreciation is expense and expenses increases on a debit side, so we will debit depreciation 59,450 and 50 cents, and we're going to credit our accumulated depreciation on computer equipment 59,450 and 50 cents. Okay, the next one what we have is we've got a debtor, Mr. D. Burnt, who owe us 1,689 Rand. But unfortunately this guy has been declared insolvent. What we do receive though is 75 cents for every 1 Rand which he owes us. Okay, so we basically receive 75% of what he owes us from his estate. And we still need to record this transaction. So we still need to record that we received this money in our bank account. And then what we need to do with the remaining 25% is we need to write off the rest of the debt as irrecoverable. So this has two parts. Firstly, we need to record the money which we received, and that will also decrease our debtors control. And then secondly, we need to write off as a credit loss or an expense the remaining money which we did not receive, and that will also then decrease our debtors control. So if we have a look at it, we received Mr. D Burnt, he owes us 1,600 Rand and 89 cents. That what we receive from him is 75% for every 1 Rand that he owes us. So we received 1,267 Rand in our bank account. Bank we know is an asset, so if assets increase, then you will debit it. So we're going to debit our bank account by 1,276 Rand, and we're going to credit our debtors control for Mr. D. Burnt because he now basically paid us back. Well, he didn't. Yeah, he paid us back what he owed us, or a portion of what he owed us. So his liability towards us decreased by 1,200 Rand and 67 cents. Okay, so that's looking at recording what we received, but as you know, we need to write off the remaining of his debt as irrecoverable. So he owes us 1,600 Rand and 89 cents, and what we're going to do is we can just subtract this 1,267 cents which we received from him. So 400 Rand and 22 cents we're going to write off as irrecoverable. So the account that we write off is a credit loss. Okay, and that is an expense to you. And expenses increases on the debit side. So let's just and so we're going to debit our credit loss, and we're going to credit our debtors control for Mr. D. Burnt. So now Mr. D. Burnt has no liability towards us anymore. He doesn't owe us any money anymore. Okay. Okay, so next what we have is an allowance for credit losses of 6% of trade receivables should be maintained. So what do we have? We have our allowance for credit losses at the beginning of the year was 1,778 Rand and 77 cents. Okay, what we want to do is we want to look at our trade debtors, which is our debtors control of 35,575 and 43 cents. We need to adjust for this Mr. D burnt, which we wrote off, and we then need to determine what our allowance for credit losses for the year should be. We want to maintain 6% of our trade receivables. So if we calculate that, we know that our trade debtors is 35,575 and 43 cents. We know that this trade debtors decreased by this 1,689 cents from Mr. B Burnt, which we received from him, and the remainder we wrote off. So in other words, what is still owed to us by our debtors is 33,974 and 54 cents. We want to maintain an allowance for credit losses at 6%. So our allowance for credit losses for the current financial year is then 2,038 and 47 cents. Okay. Comparing that to the previous year of 1,778 and 77 cents, we know that our allowance for credit losses now increased. So it's more than what we expected it to be. So if your allowance for credit losses increase, then that will mean it's an expense to you. So our expense will then be 259 Rand and 70 cents. So expenses we know increases on the debit side, so we're going to debit our allowance for credit losses adjustment account 259 Rand and 70 cents, and we're going to credit our allowance for credit losses 259 Rand and 70 cents. Okay. Next, so that's looking at allowance for credit losses, but what we also want to do is adjust our allowance for settlement discount granted, and this should be at 3% of good book debtors. So in order to determine our allowance for settlement discount granted, we need to look at our trade debtors. We need to adjust for this Mr. D Burnt, who does not owe us that 1,600 anymore. And then we need to subtract our new allowance for credit losses, which we just determined. And then that value we then need to maintain at 3%. So our allowance for settlement discount granted for the current year is then going to be 958 and 8 cents. What was it at the previous year? Previous year it was 426 Rand and 91 cents. So again, this allowance for settlement discount granted, it increases in value. It's an upward adjustment, and if it's an upward adjustment, then that means it will be an expense. Okay, so it should be 958 cents, 958 Rand and 8 cents. Previously it was 426 Rand, so there's an upward adjustment of 531 Rand and 17 cents. So we're going to debit our expense account, being our allowance for settlement discount granted adjustment by 531 Rand and 17 cents, and we're going to credit our allowance for settlement discount granted account 531 and 17 cents. Okay. Then we've got 503 Rand and 59 cents, has been recovered in cash from a debtor whose account had previously been written off as irrecoverable. No entry has been made yet. So previously we wrote off this guy as a credit loss. We knew that we wouldn't get any money back from him, so we just wrote him off as a bad debt. Now this guy came back to us and he said, "Hey, I owe you this money. I want to pay this back." So we received 503 Rand in our bank account. So our bank account increased by that. So we'll debit bank account, and then we're going to credit as an income our credit losses recovered. Okay, so our bank increases, so we will debit bank 503 Rand and 59 cents, and then we're going to credit our income, and income we know increases on the credit side. So we will credit our credit losses recovered account by 503 Rand and 59 cents. Then we've got our electricity expense for March has not yet been paid, 2,572 and 93 cents. So this is going to be an accrued expense. This is an expense which we still need to pay. So our electricity, that expense has to increase, and if expenses increases, then you will debit it. So we're going to debit our electricity 2,572 and 93 cents. And we know that we still need to make this payment, so it will be an accrued expense. And accrued expense is a current liability to you, so you will credit 2,572 Rand and 93 cents in terms of accrued expenses. Then we've got repairs and maintenance for April has been prepaid. So again, this was an expense which we incurred, but this expense relates to the next financial year. So it's the prepayment, prepaid expenses. So we made this expense, but now our expenses has to decrease because it doesn't relate to the current financial year. So we're going to credit our repairs and maintenance by 1,635 and 25 cents, and we will debit our prepaid expenses in our current asset. Okay. So again, your accrual concept states that anything relating to the current financial year should be recorded in the current financial year, and anything which does not relate, we need to take out, and we need to record it in the next financial year or previous financial year. Okay, and then commission income has not been received for March 2006, 8,085 and 32 cents. So this is commission income is an income to you. It's an income which we earned, but we haven't received it yet. So our commission income has to increase, and we know that income increases on the credit side, so we're going to credit 8,035 and 32 cents, and we're going to debit our accrued income account, which is just an income which you still need to receive. So that's going to be your current asset to you. Someone owes you that money. And then we've got the services income for April has been received already. So here again we received an income, but we received it in advance. It doesn't relate to the current financial year. So our income has to now decrease, and if income decreases, then you will debit that account. So we're going to debit our services income account by 4,599 Rand and 26 cents, and we're going to credit our income received in advance, 4,599 Rand and 26 cents. Next, what we have is an invoice for 5,275 Rand has been received from accounting online for staff trading. This transaction has not yet been recorded. So we received an invoice. An invoice normally relates to you buying something on credit. Okay, so in this instance, we did an online staff training, and the expense of the staff training was 5,275 Rand, and we still owe Accounting Online this money. We haven't recorded this transaction yet, so we just need to record the transaction. So if we record that, then we know that our staff training expense has to increase, so we're going to debit staff training 5,275 Rand, and we're going to credit our creditors control, and that is we own Accounting Online this money. So our liabilities increases on the credit side. Then we've got an amount of 9,524 Rand, which was paid to Pizza Transport for delivery by rail of trading inventory to the business. This was debited to the insurance expense account in error, and this we haven't corrected this error yet. So we went and we, in error, recorded this 9,224 Rand as an insurance, but it actually relates to carriage, carriage on purchases. So what we need to do is we need to decrease our insurance account by this 9,524 Rand, and we need to increase our carriage on expenses by this amount. Okay, so we need to correct this error. So if we correct it, then our insurance expense has to decrease by 9,524 Rand, and which we will credit, because expenses, if your expenses decrease, you will credit that, and we're going to debit our carriage inwards, being the actual expense where it does have to go to, by 9,524 Rand. Okay. Then the owner, he took trading inventory for personal use. The selling price is 6,000 Rand, and we use a markup of 60% on cost price. So because he's taken inventory, we need to take out the inventory cost. We cannot take it out the selling price, because the owner didn't buy this inventory. He just took the inventory as per the cost price. So in order for us to get the cost price, we need to take the selling price of 6,000 Rand. We're going to multiply it by 100 and then divide by 160 Rand, 160%. So the cost price of this inventory which the owner took is 3,750 Rand. He took it as drawings. Drawings we know increase on the debit side, so we're going to debit our drawings account by 3,750 Rand, and we're going to credit our purchases because we're using the periodic inventory system. We do not, in the periodic inventory system, you do not have inventory, you use purchases. We refer to stock as purchases, and purchases is an expense to you. So this is that your purchases expense decreased by 3,750 Rand. Okay, then we did a stock take, and in our stock take we revealed that our trading inventory was 24,487. This we do not need to make a general journal adjustment for, but we will record it when we determine our cost price. So we'll get to that in a minute when we look at our statement of profit and loss and other comprehensive income. But our office consumables and stationery, so these are all expenses which we incurred during the year, but it was still stationery which we can use, which we didn't use up during the current financial year. So we can use it for the next financial year. So we need to take that out. And the same for office consumables. So our stationery and office consumables, consumables. These expenses has to decrease by 5,138 and 67 cents and 10,261 and 54 cents respectively. And then our consumable stores on hand, being an asset, will then increase in total by 15,421 cents. Okay. And then finally, what we have is we need to provide for interest on the bank loan. Interest is calculated at 8% per annum, and the liability was increased by 158,500 on the 1st of March 2016. Okay, so and what was our liability at the end of the year towards our mortgage loan? So that would be bank loan of 395,282.55 cents. So what we need to do is we just need to determine our interest expense for that period. So we're going to take our balance of 395,282 less than by the amount which it increased. So then at the beginning of the year, our bank loan was 236,782 cents. That we're going to calculate our interest expense at 8%, and that's for 12 out of 12 months. Then we went and we increased this loan by 158,500 Rand, and we increased it on the 1st of March 2016. So for 1 out of 12 months, this value went and accumulated interest at 8%. So the total interest expense for that 1 month is 1,056.67 cents. So our total interest expense is then 19,999.27 cents. Okay, so that's looking at all our adjustments within our general journal. Now we need to take all this information and we need to input it in our statement of profit and loss and our statement of financial position, as well as the notes to the financial statements. Okay, so remember, you always start with your heading. So you've got your statement of profit and loss and other comprehensive income for the year ending 31 March 2006. So we've got our revenue. Our revenue is our sales less our sale returns. So what was our sales? Where do we get that? We get it from our nominal accounts section. Our sales is 1,458,671.67 cents, less than our sale returns of 64,272.94 cents. What we also need to subtract is our settlement discount granted, but in this question we didn't have any settlement discount granted. So we're just going to say sales less sale returns. So our total revenue is 1,394,398.73 cents. Then from that we need to subtract our cost of sales. We're now dealing with the periodic inventory system. How do we know we're dealing with the periodic inventory system? Well, if you find that there's a purchases in your trial balance, then you know you're dealing with the periodic inventory system. If it says cost of sales, then it's going to be the perpetual inventory system. And if it's periodic inventory system, you need to determine your cost of sales. So you're going to take your opening trading inventory. Where do we get that? That we get from our trial balance. So our opening trading inventory is 21,740.54 cents. We need to add to that our purchases. Our purchases was 667,955.57 cents, less than our purchases returns of 99,294.98 cents. Okay, so it's our trading inventory, so opening balance of 21,000, our purchases of 667,000, less our purchases returns, and then less our drawings of 3,750 cents. 3,750. So our total purchases was 564,910 and 59 cents. We need to add to that any directly attributable cost in getting this furniture, this inventory ready. So that will be our carriage on purchases, which is carriage inwards of 10,814 and 93 cents. But remember, what we did is we made an error in which we recorded this 9,524 Rand as insurance, but it should actually be carriage inwards. So our carriage inwards has to increase by 9,524 Rand. Okay, so in total our carriage inwards is 20,358 and 93 cents. And then we just need to take our closing trading inventory balance, and that we get from our additional information. So here we did a stock take, and we found that our trading inventory is 24,487 and 90. Sorry. So it's our trading inventory here from our stock take. Okay, and that we're going to subtract. And if we do that, then we get a cost of sales of 582,502 and 12 cents. So our revenue less cost of sales gives us a gross profit of 811,896 Rand. Then we need to add our other income. So firstly, we go to our trial balance. What was our other income? So it's going to be our commission income of 88,938 and 57 cents. It's going to be our services income of 59,790 and 44 cents. And it's going to be our credit losses recovered of 5,920 Rand and 24 cents. Okay, so our services income of 59,790. What else did we do in terms of services income? We know there that our services income has to decrease by 4,599 and 26 cents because we received that in advance. So we received that for April already. So that needs to decrease by 4,599. So our total services income was 55,191 Rand. Our commission income, according to our trial balance, our account is 88,938 and 57 cents. But remember, with towards commission income, we went and we are still owed a commission income of 8,038 and 35 Rand and 32 cents. So our commission income has to increase by the 8,085 and 52 cents to get to 97,023 and 89. And our credit losses recovered according to our trial balance was 5,929 and 24 cents. Add to that was this guy who went and he paid us back at a later stage of 503 Rand and 59 cents. So our total credit losses recovered was 6,432 and 83 cents. And then the only other income that we have is our interest income. And for that, we're going to have a look at note number 1. So in note number 1, our other interest will then be dividend income. So dividend income, that will then be that we refer to as interest income. That's the same as that. So we're going to add our dividend income of 9,486 Rand towards with our interest on debtors account of 6,719.80 cents. So our total interest income is then 16,206.58 cents. Okay, giving us a total other income of 174,000, which we add to our gross profit to get to a gross income of 986,751.09 cents. We need to subtract our distribution, administration, and other expenses. So firstly, our electricity. What was our electricity expense? Well, if you look at our trial balance, it was 28,302.23 cents. But towards electricity, our expense has not yet been paid. So that is an expense which we incurred, but we still need to pay. So our electricity expense has to increase by 2,572.93 cents. So in total, our electricity expense for the current financial year is 30,875.16 cents. If we have a look at our credit losses, our credit losses for the year was 9,644.89 cents. But remember, we've got Mr. D burnt, and Mr. D burnt we wrote off 422 cents. So our credit losses increased by 400 Rand and 22 cents to get to 10,045.11 cents. Then we did our allowance for credit losses as well as our allowance for settlement discount granted, and for both of these we found it to be an upward adjustment, and if it's an upward adjustment then we know that it is an expense. So we're going to record our allowance for credit loss adjustment expense 259 Rand and 70 cents, and we're going to record our allowance for settlement discount granted adjustment expense of 531 Rand and 70 cents. Okay. Then if we look at our insurance expense was 27,986 Rand, but remember we made this error in which we debit our insurance account in error. So in other words, our insurance account has to decrease by this 9,524 Rand because it doesn't relate to insurance. We made an error in recording it as insurance. Okay, so our total insurance is then 18,462 Rand. Then our office consumables and our stationery has a balance of 9,882 and 18,657, but we did a stock take and we found that we still have 5,138 Rand and 10,261 Rand respectively towards this office consumables and stationery, which we can use for the next financial year. So we need to decrease these expenses by this amount. And if you do that, then we find that our office consumables expense is then 3,090 and our stationery expense is 5,469.50 cents for the year. Then our repairs and maintenance, our balance is 21,258.50 cents, but with repairs and maintenance we prepaid for April 1,635. So this is an expense, doesn't relate to the current financial year, so we need to decrease our expenses by 1,635 Rand to get to a repairs and maintenance for the current financial year of 19,623.05 cents. Our staff training, there our expense was 10,672.63 cents, but we had this invoice which we stole of 5,275, which we haven't recorded yet, so we still owe them money, so our expenses increased by 5,275. 276 Rand to get to 15,952. Okay, and then our rent expense, wages and salaries, telephone and office refreshment. There weren't any other adjustments to this, so these amounts you can get just like that in your trial balance. And then the final expense is our depreciation. So it's our depreciation in terms of furniture and fittings, and for computer equipment, 35,568 plus then 59,450. So our total expenses for the year is then 566,487, and then our profit before finance costs is then 420,263 and 36 cents. Okay. So if we look at our interest expense, note number 2, what were our interest expenses for the year according to our trial balance? Well, it's going to be our interest on creditors account of 6,877 and 92 cents. And it will then be this interest that we still needed to provide for. So this interest of 19,999 and 27 cents. If we look at note number 2, it's going to be the interest on bank loan of 19,999 and 27 cents, and our interest on creditors account of 6,877 and 92 cents. Our total interest expense is 26,877 and 19 cents. Okay, and if you subtract that from our profit before finance costs, we get a total profit or total comprehensive profit for the year of 393,386 and 17 cents. So that's your statement of profit and loss and other comprehensive income. Next statement is our statement of financial position for the year ending 31 March 2006. So that's divided into your assets, your equity, and liabilities. If we let's start with our equity. So we take our capital as per the beginning of the year. Where do we get that? That's just our balance of 790,565 and 10 cents. Our drawings for the year was 3,952 Rand and 83 cents. But our drawings also increased by the owner taking this 3,750 3,750 Rand worth of drawings for personal use. Okay, and we need to add our profit for the year of 393,000 Rand because that increases your equity. It increases the owner's wealth when the business makes a profit. Okay, and if you do that, then we've got our capital balance as at the end of the year of 1,176,248 and 44 cents. Let's have a look at our assets. So our assets is our property, plant, and equipment, and our available for sale financial assets. So these are non-current assets, are long-term assets. And for that, we have your notes. So property, plant, and equipment, the only addition to this is the furniture and fittings which we bought. And you need to take note that it's as at cost price. And your depreciation for the year which you need to account for. So in your trial balance, you've got the closing balance towards your land and buildings, furniture, fittings, and computer equipment. You also have the beginning balance in terms of accumulated depreciation for furniture and fittings and computer equipment. So everything else you need to determine from the information on hand what you have. Okay, and if you do that, then you've got your total property, plant, and equipment of 1,571,887 and 37 cents. Then our available for sale financial assets, that's going to be our long-term investments, and the only long-term investments we have is our 10% preference share in Santoro of 94,867 and 81 cents. Okay, so our total non-current assets is then 1,666,755.18 cents. What are our current assets? So that's going to be our inventory, trade and other receivables, and cash equivalent. For inventory, where do we get our information? Well, all the information relating to inventory you just get in this additional note. So your inventory, you're going to take your stock take or your trading inventory as at the end of the year of 24,487.94 cents, and your office consumables, these two you will also then add, just the 5,138 and the 10,261. Okay, so trading inventory will balance as at your stock take or the end of the year, and then your stationery and office consumable stores on hand. So total inventory is then 59,888.15 cents. Then our trade and other receivables, there we look at our balance for trade debtors of 35,575.43 cents. Remember, we had this Mr. D. Burnt. He was declared insolvent, so we received 75 cents on his insolvent estate, and the rest we wrote off. But that means that this full 1,600 Rand and 89 cents, Mr. D. Burnt doesn't owe us that money anymore. Okay, so our trade control is then 33,974.54 cents. Then we need to determine we determined here our provision for credit losses to be for the current year 2,038.47 cents, and our provision for settlement discount granted was 958.08 cents. So if we subtract that from our trade debtors, then we get our net trade debtors of 977.99 cents. And finally, we just need to account for any accrued income and prepaid expenses. So our accrued income was our commission income, 8,085.32 cents, and our repairs and maintenance of 1,635.25 cents. And if there's any deposit, you also need to account for that. So in your trial balance, you'll find a telephone deposit of 3,577.54 cents. Okay, cash and cash equivalent in our trial balance, that will be our petty cash of 4,348.11 cents, our bank account of 20,554.69 cents, and our cash float of 10,672.63 cents. But take note, in your bank account, we received 1,200 Rand from Mr. D. Burnt, and we also received our credit losses recovered of 503 Rand and 59 cents. So our total bank account is 22,258.95, and then add that at your petty cash and cash float. So our total cash and cash equivalent is 37,279.69 cents. Okay. So if you add all your assets together, then you've got a total assets of 1,788,179.12 cents. Now let's have a look at our long-term borrowings or our liabilities. And our long-term borrowings is going to be our bank loan of 395,282.55 cents. So that's our loan which we took out, but that loan we need to break up into what is the long-term portion and what portion relates to the shorter term. So less than 12 months. So less than 12 months will then be installments. So every month we're going to make a payment of R3,623.42. So that's going to be our short-term portion, and that we need to take out from our long-term loan and record it as our short-term portion. So our loan is 395,282, but our short-term portion is this 3,623 Rand, which we pay for 12 months, for every month for the next year. So short-term portion represents 43,481.04 cents. And our long-term portion is then 351,801.51 cents. So if we record that, we're going to record our non-current asset, non-current liabilities being our long-term borrowings, and then under our current liabilities we're going to record our short-term portion of our mortgage loan, 43,481.04 cents. Okay, and then the final one is just your trade and other payables. And your trade and other payables, what we have is we've got our creditors control of 31,899.95 cents. We've got our credit card and SARS, what we owe to SARS. And obviously you also need to include your income received in advance and your accrued expenses. Okay, if you add all of that, and then remember that staff training which we had. So if you add all of that, then you've got a trade and other payables of 216,648.13 cents. Okay, and then our equity plus our liabilities equals 1,788,179.12 cents, and that equals our total assets. Okay, so that was quite a lot to go through and a lot of understanding. But basically what you need to know is you need to look at your financial statement formats. You need to know them off by heart, and you need to just slot in all the information in where you get it. You need to know how to do it in your general ledger, as well as this full set of financial statements, including the notes to the financial statements. Okay, so that's basically it relating to this learning module 10.